what is making a good suburb a good suburb. Let's unpack one suburb at a time. What is coming through in the top fives? We are super pumped to have a doctor, a data nerd, a property nerd, data wizard in the office today to unpack where to be buying in 2026 and beyond. And I think for the purpose of demonstrating how this comes to light, let's do it the proper way, right? Let's unpack it in a proper way. We're going, let's make the assumption, and you and I here, we're going to build typical property investor brief, right?
Yes.
What we see is we've got a budget of 750. We're going for a long-term investment horizon of 10 years. The general investor wanting to build up their capital base.
Are we focusing capital growth or cash flow?
Your pick.
Well, if you're buying residential assets for cash flow, I don't think you're gonna reach financial freedom in a non-stressful way.
Exactly right. So let's focus on the capital growth component aspect, because we all know yield can be manufactured, whereas capital growth is a lot harder to manufacture by ourselves. On the basis of this, we'll then look at an equity extraction time frame of 3 years. And we have now, in the most simple manner, set a typical investment brief at 750k purchase, long-term horizon of 100k, wanting to build the asset base and focus on capital growth, and an equity extraction of 3 years. So what this means is coming back in 2028 or 2029, thereabouts, and wanting to make and extract equity to fund future property
So the equity
purchases.
extraction essentially means exactly that, but it means that the area that we are picking should generate at least 20% growth within that time frame for us to be able to extract equity and then leverage into additional purchases. Because if it generates 5, it's between 20 to 30 it needs to. And when I say 20 to 30, not as in compounded, but you just add the growth rates in 3 years and you should get to 20 to 30,
So we've built our investment brief, we've qualified and understood the metrics that define a good suburb. Now we're going to get into the juicy part. The juicy part is let's unpack one suburb at a time. What is coming through in the top fives?
We have Williams Landing as the top choice, Doreen as the second, Mernda, Hoppers Crossing, Sydenham.
Let's unpack one at a time. And I might ask you, right? A lot of these suburbs have not made the headlines as of 2025 time of recording. Why is Frankston, as an example, which is a hotspot, not coming across in our search?
First, it doesn't come in the search because it doesn't meet the criteria for our brief.
And the reason why I mentioned that, Matt, goes to prove there's a method to madness of why certain suburbs are getting chosen or why certain suburbs are being ranked. And that's what I want to unpack next, right?
Yeah, absolutely.
So let's unpack the first one on your hit list.
So Williams Landing, I really like this suburb. I'm going to make it hard for myself to buy now that I'm talking about it. I like this suburb for so many reasons. It's hitting the 4% growth in the last year, so there is momentum there. If I look at it, there's a bit of potential for the uplift there. There's room disparity between 3 and 4. Industry is very diversified. When I say very, it's not perfect, but it is diversified. The industry diversification index is sitting at 71. The infrastructure spending is 10,693 per capita. So that's phenomenal. And why is that phenomenal? Let me just say, and I know for a fact what's happening in Williams Landing, but if you see an industry that's diversified, and then you see a lot of infrastructure spending per capita, that is a great precursor for population growth. And if you look at the population forecast, Williams Landing and that whole LGA is forecasted to grow phenomenally in the years to come. Okay, so that just reaffirms, the thesis of pairing industry diversification with infrastructure spending. When I look at the typical price curve, it's been steadily going up. There's no sharp deviations to the downside, which means that if there is vacant land for development, it definitely hasn't affected in the past. So the other thing that I look at is I look at the growth rate cycle. This area since 2009 has seen the lowest point of negative.
Zero.
The lowest point of negative growth was minus 0.87, which means that it's very stable, which means that whoever invested in this area has really leveraged the compounding effect. It spent 222 months in the positive growth zone. But what I particularly like about this area is that if I look at growth pattern deviation, again, a metric that's developed by HSAG, and I'll supply the dictionary, it hasn't been outgrowing itself for 2 decades. So it has been growing 13% or 12.08 less in the last 3 years than 3 years before that. It has been growing 20% less in the last 5 years than 5 years before that, and then 25% less in the last 10 years than 10 years before that, which means that it is perfectly positioned for the counter-cyclical investment thesis, you know. But that's not the only thing, you know. But if I compare this, let's say if you look at some South Australia areas, nearly all of the South Australia areas have outgrown itself. So GPD, or growth pattern deviation, compares the area's growth to itself, And in South Australia, what you usually see is that you usually see in the last 3 years it was outgrowing itself. In the last 5 to 5 years before that, it was outgrowing itself. So it's been outgrowing itself for 2 decades, you know. This one hasn't. Another thing that I particularly like is that the socioeconomics are very high, sitting at a 10.
You can't get any higher.
Well, I'm not sure.
I don't know if you can get past the 10.
Toorak in Melbourne is 10, yeah? So just a bit of a comparison. So
East versus West. Yeah. That's what you get.
So it's a 10. It's like very high levels of affluence, while the area has an affordability index of less than 30.
That is absolutely
so it's unheard of for this price point.
Yep.
Okay. So for a price point of an average, so a typical price is sitting at 809. For that price point and that level of affluence to sit at below 30 years to own, which means that the average household in Williams Landing takes 30 years to actually pay off their mortgage, essentially, you know. And you know from comparing other suburbs that is extremely rare for this price point, you know.
So while you're mentioning affordability, and you did mention Toorak, its affordability index, take a guess.
80.
It coincidentally sits at 80.3 years to own.
Yeah.
And has taken a bit of a dip recently. At its highest peak, we were at 93 years. So that's 3 times of that of Williams Landing.
Well, the ERSAT is the same.
Whilst the ERSAT is the same.
ERSAT is in socioeconomics, affluence,
It's the same, but obviously we're dealing with a very different price point at a $3 million mark. So even at a $3 million purchase price, at a 10 ERSAT, people living in Toorak will take 90 years to pay off their home.
Exactly.
In a coffin down.
Exactly. And just look at, and this is what analysis is, you know. Now people will say, you know, I don't want to go down that lane, but essentially, you know, even if Toorak grows 2% on a $3 million home, the cash and cash returns might be higher, you know, or something like that, you know. But the growth rate that's going to be generated from Williams Landing, the average annual growth rate in the future, will by far outpace Toorak because of the affluence purchasing power while it's still affordable, you know.
But not only that, beautiful stock on market, only 8 listings at the moment, and that sharp decline short-term wise.
Yeah, so look at that. Yeah, so it's long-term stock on market is reducing, which means supply scarcity has been increasing in the last 5 years, as well as short-term is reducing. And this is very important for the notion of perpetuity. So what does that mean? Well, because property is an illiquid asset, it doesn't exchange hands on a regular basis. When you have a trend in something, it's enduring a certain amount of time, you know. So if both trends, both short-term and long-term, are actually reducing, that means it will continue doing so into the future for longer until it reaches the flat line or the equilibrium, you know. So I know that it will remain scarce for long periods of time, at least 4 years.
Yep.
And we're coming back to the equity extraction time frame. And about the demand, what do we see on demand side? We see demand has actually been improving in the last 5 years, but there's a sharp deviations when it comes to the short-term trend. It is dropping phenomenally short-term demand expressed as a reduction in days on market. It has dropped substantially because you see the curve is very, I guess it's a big angle there, you know, sitting currently, while sitting at 36 days, 3-month rolling average. So as a buyer's agent, let's say if I'm a buyer's agent or a purchaser, I'm thinking, okay, 36 days, 3-month rolling average. It's not a 25 or 18 like Mount Louisa, where I don't even have enough time to do a pest and building inspection and I need to buy a property. Yeah. So I have enough time to actually choose the right asset. It's not flying off the shelf, and yet short-term demand has been improving phenomenally. So it's a perfect timing. Like this is as close to as perfection as you can get.
Let's move on to number 2.
So what do we see in Doreen? Industry diversification, infrastructure spending at $500. That's still high in the overall context because anything above 100 or 200 per person is decent. I'm just flying through the suburb pages. Again, minimal growth in the past, minus 2.24. And just to give you a bit of information, GRC minima, if it's above 5%, as in it's less than minus 5%, it's 4, minus 4, minus 3, that's phenomenal Australia-wide, okay? And that's a great, by the way, has a very high correlation to short-term growth if your GRC minima is above minus 5%. So that's what we see. We also see that the area hasn't been outgrowing itself. The socioeconomics are high, sitting at 8. The affordability index, it's a little bit more unaffordable, but when it comes to, which is sitting at, what is it,
39?
39 for a price point of 960K. So the reason why this came into the shortlist is because we went 750, which means you can buy a 3-bedroom. So the affordability index for a 3-bedroom is not going to be 39, it's going to be 32. So it's still affordable, very affordable. So Doreen, it will be a 3-bedder. Looking at supply and demand, again, same thing. Supply scarcity continuing while we see short-term divergence. Demand is improving. See, in this instance, it's 21 days on market.
Which is
it's acting like a hot market.
It is in the context of Vic.
Yeah.
3-week campaign, get sold, done, hot market.
Correct. And see, both Williams Landing and Doreen, people will say, well, the vacancy rate is high. Again, there's no perfection. We are after growth. Vacancy rate is a cash flow producing metric. You want to buy an asset that's going to be rentable, look at the demographic profile of the area, try to fit it to the demographic profile, allow more money for vacancies, but you'll get the growth.
Yep.
So the return is going to outweigh the extra week you have to pay to actually for a vacant property.
Number 3.
Mernda. Okay, 745 typical price. You can buy a 3-bedder, 687. What do we see? Woof, look at this infrastructure spending. Very diversified industry. Infrastructure spending is at nearly 12K per person. What's happening in Mernda, man? What are they building there?
Houses.
Mate, they must be building the Golden Gate Bridge, mate. Look at that. That's a lot. That's a lot. So, all right, what else do we see? Again, the suburb wasn't outgrowing itself, seen minimal negative growth in the past. It spent a lot of time in the positive growth zone. Compounding did its effect. High side of 7, everything above 5 is great. Lower rent to owner ratio, 27%. Still very affordable, sitting at 32 years to own or 33. What do we see? We see supply scarcity increasing. Short term, there's a bit of an uptick, but it's still sitting below the trend line of the long term, which is great. Short term demand improving, sitting at 27 days. Vacancy rate is high at 3.77. So again, some skills need to be applied when it comes to acquiring an asset, but when it comes to growth, everything is aligned for growth in this area.
And I think, dealing with high vacancy rate throughout the asset selection, one of the key criteria could potentially be choosing an asset that already has a tenant in.
Absolutely.
Which rolls over.
Absolutely.
As opposed to then minimizing or de-risking a higher vacancy rate is one of the asset selection approaches that we
See, what you just said there is very important. So, okay, if you want to deal with the vacancy rate, you find an asset that's tenanted, but then that asset doesn't have to be perfect. It doesn't have to have rooms that are 2.5 by 2.5. Mm-hmm. You can make certain you're bound to make compromises, but if you want to reduce the vacancy rate, find a tenanted asset. As simple as that.
Absolutely right. And in the context of Melbourne, where you've got minimum rental compliances, you are buying an asset which is already rental compliant, as opposed to taking an owner-occupied asset on vacant possession, having to go through rental compliances and then finding a tenant. So that's different ways of how we then mitigate that asset selection, as opposed to seeing a bright red and run away. We run into it with the right preparation to get an asset that is going to grow. That's why the professionals
exist, exactly. You know, and that's why I asked you at the beginning, what are we? Are we after growth? These are the growth suburbs. The next one, Caroline Springs, yeah?
Yep.
Melton, wow. Are we allowed to say this?
Go for it.
Melton?
It's not banned in my lingo. I know it is banned in some people. You might have machetes come across you.
Melton. Wow, Melton is going to... Yeah, by the way, I love Melton. LGA has got some great suburbs. So you can afford a 3-bedder, 732. Interestingly enough, the 3 bedrooms have moved the most in the last year, that have grown 6.11%. So just goes to show that it's the most desirable asset. Industry diversification, infrastructure spending is also there. No exposure to flooding and bushfires. I'm just going to plow through the most important things. What do I see as well? Minimal negative growth in the past. A lot of time spent. They're very similar. I see these suburbs that are in the top, you know. A lot of time spent in the positive growth zone. It hasn't been outgrowing itself. And growth spillover potential, GSP metric. Again, I always repeat, I'll send the dictionary. It compares that suburb to and its growth across time frames to the surrounding suburbs in the same LGA. So Caroline Springs has grown less than the suburbs that are within its LGA that surround it. You know, again, perfect timing. This is the timing effect. You know,
which is Taylor's Hill, Hillside, Fraser's Rise, Burnside.
Correct.
Which have already probably taken a little bit of a steam ahead. Correct. And now Caroline Springs tailoring from behind. But particularly what I do like a lot more about Caroline Springs, the 3-bedroom to 4-bedroom play, where your typical price of a 3-bed is $732.
I haven't even seen. Oh, wow.
And a 4-bed is at $928 and rising by 4%.
That's a $200K disparity there. So yeah, that's phenomenal. I mean, let's say you have an equity extraction time frame of 3 years, but if you find a 3-bedder that you can convert to 4, like this is life-changing money.
And that is not even an equity extraction of 4 years. Exactly. That's an equity extraction of 4 months.
Yeah.
Straight up.
No, right
do
away.
the works.
Right away.
Get
right
it valued.
Right
and boom, there you go.
And depends. You're not going to add an external bedroom. You add an internal one, as you said before, it's going to cost you $10K. You know, you do an evaluation and off you go. So, yeah, no, it's great. So looking at supply and demand, there's a bit more stock in this market. It's still trending down long term. Short term is trending a little bit up, but not much, nothing concerning. Demand, and again, do you know how I look at this? So let's say if the stock market short term is trending a little bit up, but I look at the short term demand side, and it's improving much more forcefully, yeah?
Yeah, like it's on a shorter decline.
Yeah, it's
across the past 3 months.
Exactly, and it's sitting at 28 days. Just to put it in context, guys, 28 days is a hotspot.
Let's unpack that. The reason why it's a hotspot is the property goes on market on a rental campaign, typically in Melbourne on an auction campaign for 3 weeks. So week 1, week 2, week 3, and the 3rd week it gets sold. Right, so that's a 21-day campaign. We've got 28 days here, a little bit potential of a data lag where the results are then closing off and getting updated. 28 days is an absolutely hotspot in the context of Melbourne.
Yeah, in the context of the days, this area is actually, so this is where I see opportunity. When you see hotspot signals and yet the growth rate doesn't reflect the hotspot, that's a phenomenal entry opportunity. So if you have 28 days on market, you know, which is reminiscent of hotspots, and yet the growth rates are not 30% like in Townsville or Perth, this is the whole counter-cyclical investing thesis, you know.
Yeah, this is beautiful, man.
This feels right. You're looking who's walking around. Matt looks at the number.
Well, I look at the number, but then usually it should reflect in the street appeal because socioeconomics. Like you see, this area is affluent, as in like, it's nicely kept.
But often if a city centre is well planned, and well shaped around, amenities are there, walking trails, parks are there, it tends to then ripple out in the side streets of housing. It's a hub which exists on its own. So if you cut off the streets that bring you into Caroline Springs, you could happily live here. You'd be serviced by the lake and walking trails.
There's everything, man.
You'll be serviced by the square down there where you've got Coles, local amenities.
But essentially, it's all based on population growth.
Yeah, well, we've got a population of 25,000 established here and growing population. So it's all a business hub which needs to fuel back and give back into the local economy. And that's why we are seeing the infrastructure spend of Caroline Springs at the...
Is it 10K?
I don't know. You guys can insert that. I will give you a hashtag.
It is 10K.
Is it 10K?
It's about 10K, yeah. But I am surprised at this area. Like, it looks great considering that it's, you know, I mean, 7 is still opportunistic, but it looks pretty good, man.
And again, I think that's a bit of a lessons learned for the audience out there is don't shy away if you're looking at a nurse out of 5 or even a nurse out of 6. A nurse out of 10 is the cream of the cream of the cream. Well, now in the 7, and you can see that it's somewhere.
No, absolutely.
Where you go, this feels like home. This feels like the owner occupiers are present in here. Besides, I'd say, you know what, a couple of shopping carts here and there, which...
That's all right.
The next one is Point Cook. We nearly bought there. You can buy a 3-bedder, you can't buy a 4. Look at the disparity between 3 and 5. Wow, if you can manage that, that would be great. $500,000 there. Yeah, so Point Cook, again, industry diversification. Infrastructure spending is less than the other culprits, if you will. So a little bit, only $99. When I say only, there's still some infrastructure spending per person. You can see why it's number 5. The GRC, or the growth rate cycle, is a little bit more sporadic when I look at the other ones. Again, nothing in isolation has meaning. So when I look at the other 4 and I look at this GRC, I can see that the other ones are much more predictable and they move in much more predictable cycles. This one, not so much, but nothing negative. I mean, the lowest point of growth was minus 3.14%. He spent 158 months in the positive growth zone. He hasn't outgrown itself in the 3 and 5 year time frame, but it has in the 10-year time frame. So Point Cook could actually return substantially within the first 5 years, but then after that it could taper off.
Interestingly, Matt, look at that 5-bedroom price point and look at the growth in comparison to 4 beds and 3 beds.
Interesting, yes.
Interestingly, 5 bedrooms sat at about 1.2 and has undergone a higher growth rate, almost double to that of 3 beds.
But see, you know what's going to happen there? So what is it? Let me look at the affordability index. So the affordability index, which is, it's sitting at 38 or 36. So for a price point that's $945, very affordable. So what's going to happen is that the 1.2 mil 5-bedders are going to reach a point where people are going to start diverting to the 4 and 3 because the affordability increases, you know. So let's say you can afford a 3-bedder, it's still growing 4%, you know. It's still a warm to transitioning market, you know. And let's look at the demand profile, by the way. Let's see if... And look, 5-bedders are not that much in demand, and yet they've grown the most. While 4-bedrooms are most in demand, and then 3-bedrooms are a little bit more than 5-bedders.
Yep.
So you're not buying, even if you buy a 3-bedder, you're not buying an asset that is less in demand than a 5-bedder. You know, so you'll see a divergence in purchasing when the friction cap is hit when it comes to affordability for the 5-bedders, and then people are going to start cascading down.
Or it's a simple different demographics coming back to be purchasing into Point Cook at that 3-bedroom price point.
Yeah, I mean, bottom line is if you buy a 3, even though the 5-bedder has grown more, you're not going to make a mistake buying a 3-bedder because the market dynamics is out of 9, which means that it's, you know, look at the annual sales volume, 913. That's phenomenal. And by the way, there's, you know, a lot more listings in Point Cook, which again is not a bad thing because it gives you this opportunity to choose. However, the stock on market has been going down for the last 5 years. The supply scarcity is increasing. Demand long term has been flat. Recently, you can see a bit of a divergence. I wouldn't take too much of that divergence, just because a year ago, there's been instances where days on market was extremely high, 67 days and 62. So that's why you see that divergence. But there is an improvement in demand, because you can see that in the last year, most of the bars are sitting below the trend line, yeah?
Yep.
And it's sitting at 40 days on market. Now, the 40 days on market can be because there is stock to choose, people are choosing, all of these other things. Vacancy rates are a bit higher, but the fundamentals are there in a sense that supply scarcity is increasing, hold periods are long, there is a bit of building approvals coming to the market, but I think that because of the improvement in recent demand, that's going to be absorbed, and because it's very affordable and has very high levels of affluence, this gives you the long-term steam.
And what about the infrastructure spend? Definitely being on the lower end in comparison to the likes of Caroline Springs, even Doreen, at a very slim $99 per capita.
Correct. Which is why it's at number 5. But just to put it in context, like $100 is still reasonable. Like, for example, when we were training our AI co-pilot and we're doing a correlation analysis, anything $100 and above infrastructure spend per person is in the top 20% of Australia.
Yep.
So that's still okay. Now, contextually, when you compare it to the other suburbs, it seems like a dwarf, essentially.
It is.
Yeah.
It is.
However, holistically, when you compare Australia, it's still reasonable, which is why it's number 5.
And I think what we're seeing here, Matt, is a very similar pattern.
Correct.
Right? A very similar pattern of how we're ranking a good suburb off a basis of fundamentals with supply scarcity and demand behavior by days on market, right? So you guys might have picked up on ERSAT and affordability, on renter to owner, on short-term supply, long-term supply trends, and you get these top 4 or 5 metrics in your qualifications of good versus bad.
Yep.
I would say you are 80% there of being able to pick the right location for the right investment brief.
Absolutely. And by the way, let me just hinge on something. So to produce this shortlist, the audience didn't see, but I actually compared it. I actually looked at 50 or 60 metrics, yeah?
Yeah.
Through using the DEX module and everything else. So we look to see, and you can actually see progressively as you're looking at all the other suburbs, why Williams Landing is first, why one is second. Like, you can see the opportunity cost embedded in the data.
Yeah, and I think a big key part, a key triggering metric comes down to the infrastructure spend. Economic diversity being at the forefront, giving you that long-term stability.
Minimal exposure, GRC minima was much less than the other ones. They spend much more time in the positive growth zone. They haven't outgrown itself. Supply scarcity was larger. Short-term demand divergence was greater in improving. So you can actually see why the hierarchy is there.
Exactly right. And that's why defining your investment horizon is so important.
Correct.
Because if your investment horizon was now shifted to a 4 or 5 years time frame, the importance that you would be putting into EDI, economic diversity and infrastructure spend, would have a very different ball game of ranking system. Well, what it is, markets to be looking at, keeping it to the bare bones of understanding what makes a good suburb, and really from there on, diving in, going into these suburbs, understanding asset selection, and making a purchase happen in 2026 using the right metrics of what is making a good suburb a good suburb.